Hey guys, we're back here showing you the relationship between the loanable funds graph first, as well as our aggregate demand graph. Aggregate demand graph should look familiar, so should this if you watched video part one. All right, so let's talk about what happens here if we increase our demand for money. So that's, again, if prices go up, we got to increase our demand for money. We're going to prove that with our price level, our inflation over here, GDP, okay? And also if, our incomes increase the demand for money, okay? So first of all, what we've got to understand is we're going to shift our demand, okay, to the right. Okay, that's going to give us a new equilibrium point. We know that our quantity, this is our GDP, this is Q, sorry. Okay, so first of all, our equilibrium quantity increases, right? More money, that means more money in our pockets, right? That's easy. Okay, we got more money. Now, we also know that interest rates are going to increase, okay, which means if interest rates increase, that's closely related to our price level. Okay, so we're borrowing more money. Our quantity of money being borrowed is going to increase. Let's see if we can prove that with our aggregate demand graph over here. Okay, it's going to increase our demand for money, right? And a question that they're going to ask is, hey, if the increase in demand for money, what can that be expected to do for our price level in the short run? Well, our price level is going to increase. Our real GDP in the short run is going to increase. And that's going to be the final result, okay? I did have the long-run aggregate supply curve on there just to give you familiarity with the graph. It's not important for the sake of what we're talking about right this second, okay? Now, the other thing that can do is obviously we can decrease our demand, right? So if we decrease our demand over here, so again, people's incomes go down, right? People's incomes decrease, which means now the bank can't loan me money. Okay, because now I don't have any money to pay them back, right? So we have less money over here now, right? We have less money. Interest rates are going to go down, all righty? Which over here, when interest rates go down, I'm not borrowing money. I'm not buying stuff. I have a decrease in aggregate demand. My GDP is going to decrease. My price level is going to go down, and that is going to be the end result. All right, stay tuned here. We're going to talk about supply of money next. Okay, let's talk about what happens with the supply of money when it changes. Okay, so first of all, if we're talking about strictly loanable funds, I will go over shortly here the money market in a second. Okay, if we're talking strictly loanable funds, what can happen to, how can the supply of money be affected? Well, let's just say that, an alternative way to save money, let's just say that people have decided to invest more money in the stock market, right? They don't trust banks. And so what'll happen if I want to put my money somewhere besides the bank, remember, we're the supplier of money also, right? If I'm going to put more of my money somewhere besides banks, I'm going to decrease how much money that banks have, right? Decrease my supply. Now, this does two things. It says interest rates are going to go up, okay? But the axis that we're worried about, okay, is the quantity axis for the sake of relating it to our aggregate demand graph, right? So notice the quantity of money borrowed decreases. If the quantity of money borrowed decreases, that means I'm spending less money. We're going to come over here, all right? We're going to spend less. Our aggregate demand is going to decrease. Okay, our aggregate demand decreases. All righty. So if we can't borrow money, if the banks aren't allowed to loan money out, okay, or if it's too expensive, then we're going to decrease our production. We're also going to decrease our price level. Okay, again, this axis here, right? This is the important thing. We're borrowing less money, meaning we're spending less money. Okay. On the flip side, let's just say that people lose confidence in the stock market. I don't know. Let's say that people are deciding to save more money because, somebody convinced them to, whatever. Okay. We can increase our supply of money we want to put in banks also. And well, let's just say, for example, here's a real life example. After the Great Depression, the government came out and said, hey, listen, your money's going to be insured if the bank loses it, right? It's called the FDIC. So if the bank loses your money, we'll give it back to you. Okay. So people literally took money out of their mattresses where they were hiding it, right? And they started putting it into the bank. That increased the supply of money. Okay. And the supply of money right there is going to shift to the right. Well, now the opposite happens, right? Interest rates are going to go down. We're going to have more money to borrow on our quantity axis. We have more money to borrow over here, meaning we're going to spend more money. And we see an increase in prices, and we see an increase in GDP, okay, in the short run. So pretty simple, pretty straightforward concept. You got to do it a couple times. We're going to practice it with the monetary policy a little bit Wednesday. We got one more quick thing to show you here. Okay, last thing we're touching here today, okay, is first of all, I've changed the title of our graph, right? This is our money supply market now. Now, notice too, it's pretty small on there, but notice too that I've changed my quantity axis to percentages. So the big difference, which is not going to change the result, okay, of what we eventually come to, but the money supply market is regulated by the government, okay? So I'm just gonna add that in there. Regulated by Federal Reserve, okay? Which again is the central bank. Okay, and the only thing they can do is they can only affect the supply. Now notice, basically the rule that they have is they're going to say, hey, listen, banks, you can only loan out a certain amount of money. And this will make a little bit more sense come Wednesday. Okay, so I'm going to label my quantity axis with percentages. We got 75%, 100%. So if the Federal Reserve says you can loan out 100% of your money, okay, then that's going to change some things. These numbers are hypothetical just to kind of put it to scale a little bit. But if the government says, we're just going to say that right now you can loan out 75% of your money. Now, keep in mind, banks have to loan out money to make money. Okay, if no one's borrowing money, a bank isn't going to make any money. So that's no good for them. So they want to sell their money. Well, if you have a surplus of bananas, say at the grocery store, what do you do if no one's buying the bananas? Well, I've got to get rid of it. Okay, so I've got to lower the price. I got to put stuff on sale. Banks are kind of the same way. They have to lower interest rates if no one's borrowing any money. Okay, so if we want to increase demand for stuff, well, we just did this. Well, the government's going to say, the Federal Reserve is going to say, all right, we're going to create expansionary policy. Okay, make a new supply line. All right, so this is expansionary. Also called loose money. They call it a few different things. Remember our terms that we talked about, the other day when we were talking about the difference between fiscal and monetary policy, what the government tries to do. Okay, so they increase the supply. They say, hey, listen, banks, you can now loan out, let's say 90% of your money. Okay, well, now banks got to get rid of it, right? They got to sell it. Well, what happens on our quantity axis down here, right? Now we have more money being loaned out. Okay, and it's going to come over here. We got more people able to borrow money. Interest rates have gone down, and we have an increase in aggregate demand. Okay, if we were in, let's say, a recession, right? If we were in a recession, so we have a recessionary gap right here, just to give you a quick review, monetary policy can say, hey, listen, let's do expansionary policy and try to get back to our happy point where all three are right there, right? If this is my long-run aggregate supply. Okay, on the flip side, all right, on the flip side, we can also perform contractionary policy. All right, so we got a new supply there, right? So let's just say we can only loan out 50% of our money. Well, now banks have to make more money with less product, right? So they have to raise prices so they're able to make a bigger profit. It's going to raise interest rates. It's also going to lower the quantity of money available, and we're going to come over here and we're going to decrease our aggregate demand, right? And so now our price levels are going to go down. We're going to obviously see a decrease in GDP because people can't borrow money. Okay. Again, if we were to say, we were in an inflationary gap, right? We would say, okay, well, how do we fix that inflationary gap so that we are not having inflation be too big of a problem? So remember, your inflationary gap would look something like, it would be like this, right? And here's your inflationary gap right here. Okay. And so we're trying to fix that. We'll go more into detail about that on Wednesday. Okay. Hopefully this makes some sense. I'll link you another video to that stuff. Don't be afraid to ask questions. Get a hold of me when needed. Okay, you'll see your assignment in your email. You're doing something from last time. Okay, rather than this time, we'll give you something for this stuff on Wednesday.